You have money sitting in a regular bank account right now. Maybe it's $500, maybe it's $5,000, and every single day that it just sits there doing nothing, the world's wealthiest people are quietly turning their money into more money. Here's the wild part. They're not smarter than you. They're not luckier. They just started. In this video, I'm going to show you the exact investments that are working right now in 2026 based on real global data. We're talking high-yield savings accounts paying over 4%, government bonds backed by the full faith of the US government, and index ETFs that have historically returned over 10% annually. You don't need a finance degree. You don't need a stockbroker. You don't need $10,000 to start. All you need is the next few minutes, and I promise by the end of this video, you will know exactly where to put your money. Let's go. The safety net investments. Let's start at the very beginning. Because before you invest a single dollar in the stock market, there is a foundation you need to build. Think of it like a house. You wouldn't put up walls before laying the concrete, right? The same logic applies to your money. Step 1. The high-yield savings account. Right now, as of early 2026, the best high-yield savings accounts are paying between 4.3% and 4.7% annual percentage yield. I want you to understand what that means for you personally. If you have $5,000 sitting in a regular bank account that pays 0.01%, the national average, you are earning 50 cents per year. That is not a typo, 50 cents. Now take that same $5,000 and move it to a high-yield savings account at 4.5% APY. Suddenly, you're earning $225 every year just for having your money in the right place. You didn't do anything different. You didn't take any risk. You just moved your money. Top options right now include Marcus by Goldman Sachs, Ali Bank, and SoFi. All FDIC insured up to $250,000. That means your money is backed by the US government. Elite investors keep their emergency funds here because they understand that liquidity is a form of strategy. Step 2. Certificates of deposit. CDs. ACD is essentially a savings account where you agree to leave your money for a fixed period, 6 months, 1 year, 2 years, in exchange for a higher guaranteed interest rate. Right now in 2026, 1-year CDs from top institutions are yielding between 4.5% and 5.0%. And here's the key word: guaranteed. This isn't market speculation. This is a contractual promise from your bank. Institutions like Fidelity, Marcus, and Synchrony are offering some of the most competitive rates. The strategy elite investors use is called a CD ladder. You split your money across multiple CDs that mature at different times, 3 months, 6 months, 1 year. So you always have access to some cash while always earning the highest rates. It's a technique used by family offices managing tens of millions of dollars, and you can do it with $1,000. Step 3. U.S. government bonds, treasuries. I'm going to say something that might surprise you. Right now, some of the safest investments in the world are also paying some of the best yields we've seen in over a decade. U.S. Treasury bills, T-bills, with maturities from 4 weeks to 52 weeks are currently yielding around 4.2% to 4.6%. These are backed by the full faith and credit of the United States government. Treasury notes, which range from 2 to 10 years, are yielding between 4.0% and 4.4%. And here's the elite insight that most beginners never hear. Interest income from U.S. Treasuries is exempt from state and local taxes. For someone in a high-tax state like California or New York, this tax advantage can make treasuries significantly more valuable than a traditional savings account, even at the same headline rate. You can buy treasuries directly at treasurydirect.gov with as little as $100, or through any major brokerage, Fidelity, Schwab, Vanguard, with zero transaction fees. This is your safety net. This is the foundation. Before you chase any stock market gains, you need this layer locked in. The wealth builders, index ETFs. Now we get to the part where your money doesn't just protect itself, it actually grows. And I want to be honest with you right now. This is the section that separates people who stay broke from people who build generational wealth. What I'm about to show you is exactly what Warren Buffett has told ordinary people to do for decades. This is what pension funds worth trillions of dollars rely on. This is what the smartest, most rational investors in the world quietly do while everyone else is chasing meme stocks and crypto pumps. It's called index investing, and it is, without question, the most powerful wealth-building tool available to a beginner right now. The S&P 500 VOO, Vanguard S&P 500 ETF VOO, tracks the 500 largest companies in the United States. Apple, Microsoft, Amazon, Nvidia, Google, all in one single fund. The 10-year average annual return of the S&P 500 is approximately 12.6%, including the crashes, the corrections, the pandemics, the rate hikes, everything. Through all of it, $10,000 invested 10 years ago would be worth roughly $32,000 today. The expense ratio on VOO is just 0.03% per year. That's 3 cents on every $100. You cannot find a more efficient wealth-building vehicle. As of early 2026, VOO is one of the most widely held ETFs in the world, with over $1.2 trillion in assets under management. That's not retail investors guessing. That's institutional money, pension funds, endowments, and sovereign wealth funds. VT, Vanguard, Total World Stock, ETF. If VOO is the American engine, VT is the entire global engine. VT holds over 9,500 stocks from 47 countries: the US, Europe, Japan, Australia, emerging markets, in one single fund. The logic is simple. You don't know which country or which sector will lead the next decade. In the 2000s, it was China and emerging markets. In the 2010s, it was US tech. In the 2020s, it could be anywhere. VT gives you full exposure to wherever the growth is. The expense ratio is just 0.07%. For global diversification, that is extraordinary value. VWO and SCHE, Emerging Markets ETFs. Here's where the elite insight comes in. As of 2026, valuation spreads between U.S. equities and emerging markets are at historically wide levels. The MSCI Emerging Markets Index trades at a price-to-earnings ratio roughly 40% lower than the S&P 500. VWO, Vanguard Emerging Markets ETF, and SCHE, Schwab Emerging Markets ETF, give you targeted exposure to China, India, Brazil, Taiwan, South Korea, and Southeast Asia. India alone is projected to become the world's third largest economy by 2030. The SCHE expense ratio is just 0.11%. These are not speculative bets. They are structural demographic and economic trends. Now, real quick, if you've watched this far, it means you're serious about your financial future. And I respect that. So before we go deeper, do me a favor right now. Hit that like button. Drop a comment below telling me how much you're thinking of starting with, even if it's $50. And make sure you're subscribed with the notification bell on, because next week I'm dropping a video that walks through exactly how to open your first brokerage account step by step. You don't want to miss it. Now, back to building your wealth. SCHD, Schwab US Dividend Equity ETF. Let's talk about income. SCHD is one of the most respected dividend ETFs in the world among serious long-term investors. It tracks high-quality U.S. dividend-paying companies. Companies with strong balance sheets, consistent earnings, and long histories of increasing their dividends. As of early 2026, SCHD yields approximately 3.5% annually in dividend income. and that income grows over time as the companies raise their dividends. Over the past 10 years, SCHD has also delivered significant price appreciation alongside its income. This is what income investors call yield on cost. Meaning if you invest today at 3.5%, but the dividends grow 8% per year, in 10 years you might be collecting 7% on your original investment, every year, forever. Elite portfolio construction often uses what's called the VOO plus SCHD core, half in total market growth, half in dividend income. It captures appreciation and cash flow simultaneously. Real estate, robo-advisors, and bonds. You don't need to be a landlord to invest in real estate. That's a myth, a very profitable myth, but a myth nonetheless. The reality is that you can invest in world-class commercial properties, apartment complexes, office buildings, data centers, and warehouses without ever dealing with a tenant, a leaky pipe, or a property manager. How? Through REITs, real estate investment trusts. A REIT is a company that owns income-producing real estate. By law, REITs are required to distribute at least 90% of their taxable income to shareholders, which means they pay out high dividends. As of early 2026, diversified REIT ETFs like VNQ, Vanguard Real Estate ETF, are offering dividend yields in the range of 3.8% to 4.5%. Real estate as an asset class has historically kept pace with or outpaced inflation over long periods, which makes it a powerful inflation hedge. Here's the sophisticated angle. Institutional investors, endowments, sovereign wealth funds, pension funds typically allocate between 10% and 15% of their portfolios to real estate. Not because it's glamorous, because it's uncorrelated. When stocks zig, real estate sometimes zags. That diversification effect reduces the overall volatility of your portfolio. Specific REIT subsectors worth knowing about in 2026. Industrial and logistics REITs driven by e-commerce fulfillment are showing strong rental growth. Digital infrastructure REITs, data centers and cell towers, continue to benefit from AI infrastructure expansion. Residential REITs in supply-constrained markets remain pricing resilient. Robo-advisors, Betterment and Vanguard Digital Advisor. I know what some of you are thinking. This is a lot to manage. I just want someone or something to do it for me. That's exactly what robo-advisors are for. Betterment and Vanguard's Digital Advisor are two of the most respected automated investment platforms in the world. Here's how they work. You answer a few questions about your goals, your timeline, and your risk tolerance. The platform builds you a globally diversified portfolio automatically. It rebalances, it tax loss harvests. It does everything a human financial advisor would do for a fraction of the cost. Betterment charges approximately 0.25% annually. Vanguard Digital Advisor charges around 0.15%. For context, a traditional human financial advisor typically charges 1% per year. Over 30 years, that 0.75% difference in fees can mean the difference of hundreds of thousands of dollars in your final account balance. For a true beginner, starting with a robo-advisor is one of the smartest possible moves. You invest consistently. The algorithm handles the complexity, and over time, as you learn more, you can transition to a more hands-on approach if you want to. Emerging market bonds. This is the advanced layer, and it's where institutional investors have been finding yield that simply doesn't exist in developed markets. Emerging market bonds from countries like India, Brazil, Indonesia, Mexico, and Vietnam are currently offering yields in the range of 5.5% to 8.0% in hard currency terms. ETFs like EMB, iShares Emerging Markets, Bond ETF, and VWOB, Vanguard Emerging Markets Government Bond ETF, provide diversified access to this asset class. Yes, there is currency risk. Yes, there is geopolitical risk. That is why these yields are higher. Risk and return are always linked. But here's the elite framing. In a world where developed market bonds yield 4%, emerging market bonds yielding 7% represent a significant risk premium. And with a diversified ETF, the idiosyncratic risk of any single country is dramatically reduced. Global institutional investors allocate 3% to 8% of fixed income portfolios to emerging market bonds. They do it because the math works. The yield spread compensates for the risk over time over a diversified portfolio. International diversification, the macro picture 1. The US dollar's share of global central bank reserves has declined from about 71% in 2000 to approximately 58% today. The world is gradually diversifying away from dollar-dominated assets. As a beginner investor, owning some international exposure through VT, VWO, or emerging market bonds is not just smart diversification, it is an alignment with one of the most significant structural trends in global finance right now. The complete beginner portfolio blueprint. You've made it to the part of the video that most beginner investors never reach because most people click away before they get here. But you stayed, and that decision is already separating you from the majority. Now let's put it all together. I'm going to give you 2 complete portfolio blueprints right now. One for a beginner with $500 to $5,000 to invest, and one for a beginner with $5,000 to $25,000. These are not theoretical. These are practical, evidence-based allocations grounded in how institutional portfolios are actually constructed, simplified for where you are right now. The starter portfolio, $500 to $5,000. This is the portfolio that gets you started with maximum efficiency and minimum complexity. 50% VOO, your core growth engine. S&P 500 exposure. Historically, approximately 12.6% annual return over the last decade. 20% SCHD, dividend income layer. Currently, approximately 3.5% yield, growing over time. 20% high-yield savings or one-year CD, your liquidity layer. Currently 4.3 to 5.0%. Safe, accessible, earning. 10% VWO or SCHE, international emerging market exposure. Structural long-term growth trends, currently cheap relative to U.S. markets. With $1,000, that's $500 in VOO, $200 in SCHD, $200 in a high-yield savings account, and $100 in VWO. That is a globally diversified, income-generating, inflation-aware portfolio. And here is the most important variable of all, time. If you invest $1,000 today at an average 9% annual return and never touch it, in 30 years, that single $1,000 becomes over $13,000. Now imagine you add $100 every month, that $1,000 starter plus $100 per month at 9% over 30 years becomes over $180,000. From $100 per month. That is the power of compounding. Einstein allegedly called it the eighth wonder of the world, and the data backs that up completely. The growth portfolio, $5,000 to $25,000. This is where you begin building serious long-term wealth with institutional-grade diversification. 40% VOO, U.S. Equity Core. 20% VT or International ETF, global diversification, including developed and emerging markets. 15% SCHD, dividend income with growth trajectory. 10% VNQ, real estate exposure via REIT ETF. 10% bonds, either U.S. Treasuries, 4.0 to 4.6%, or a diversified bond ETF like BND, stability and income layer. 5% EMB or VWOB, emerging market bond exposure for yield premium. This is a 6-asset class portfolio with genuine global reach. It captures U.S. growth, international exposure, real estate, income, stability, and yield premium simultaneously. Institutional allocators have used variations of this structure for decades. The core principle. Here's what I need you to understand above everything else. The best investment strategy is the one you actually do, not the one that looks perfect on paper, not the one your friend told you about, not the one you're still researching 3 months from now. Start today. Start small if you have to, but start. The single greatest mistake beginners make is waiting until they know enough. But here is the truth that every elite investor understands. The market doesn't reward knowledge alone. It rewards action taken over time. Your 60-year-old self will not care whether you started with VOO or VT. They will care that you started at 25 or 30 instead of 45. The cost of waiting 1 year at 9% average returns on a $5,000 portfolio is $450. Every year you wait costs you money. The delay is the risk. Staying in cash is not playing it safe. Inflation at 2.5% to 3% annually is guaranteed erosion. Investing is the only rational long-term response. So let's recap exactly what we covered today. You now know about high-yield savings accounts paying over 4%, certificates of deposit locking in guaranteed rates up to 5%, U.S. Treasury bonds, the safest investment on earth, paying 4% to 4.6% with tax advantages most people miss. You understand VOO, the S&P 500, one of the greatest wealth-building tools in history. VT for total global diversification. VWO and SCHE for emerging market exposure at historically cheap valuations, SCHD for growing dividend income, VNQ for real estate without being a landlord, robo-advisors for automatic intelligent investing, and emerging market bonds for the yield premium that institutions quietly harvest. You have two complete portfolio blueprints. You understand compounding. You understand that waiting is the real risk. This is what it looks like when a beginner walks into the conversation armed with the same information as an elite investor. Now, your homework. Choose one account to open this week, not next month, this week. Whether it's a high-yield savings account, a brokerage account for VOO, or a robo-advisor, just start. This is not financial advice. This video is for educational purposes only. If this video helped you, hit that like button right now. It takes 2 seconds and it helps more beginners find this information. Hit subscribe and turn on that notification bell because every week I drop new content to help you build real, lasting wealth. You've already taken the first step by watching this. Don't stop now. I'll see you in the next one.